Now we'll move on to conduct and culture. You obviously, with the FMA, did the review of banks last year, and the life insurer report came out more recently, but we'll focus on banks today. You've asked them to report back by the end of March. You've obviously given them individual reports. Once they report back, where does it go from there?
Well, we'll be working very, very closely with the boards of those banks and the senior management to see, how seriously and committed are they to those findings, because a lot of the findings was about preparedness to invest in frameworks, rearrange the importance of agendas, understand the incentive structures and whether they are driving the kind of long-term financial outcomes that society and customers expect. And so that will be a lot of intensive work with them. I think it'll be quite telling straight up very, very quickly. I have to say the vibe so far has been good. Everyone seems to be very busy and working on this, and we're being told that they hear us, they do it. At the same time, we hear about the capital and the relationship and stuff, so there's still kind of competing noises. But we're looking forward to seeing that on the way through. The follow-ups will be making sure that they are committed to those plans and that we can see those plans progress. An end outcome for us is that we provide regulatory impost around particular activities, and/or we make it more transparent as to who's not doing what we believe meets these standards. So as I said on the day, it's the end of the beginning, and it's certainly not the beginning of the end. We're not alone. There's so much noise globally. I think capital helps enormously on taking away the desire of trying to make humans behave in a consistent fashion.
Now, one of the changes that you're asking banks to make is removing sales incentives from their pay structures, which, as you'll understand, is a pretty major fundamental change for banks. Some of the feedback I've got on that is some of them are a bit, I don't know if surprised is the right word, probably not surprised, but it's a big task for them to implement.
I think what we got, and I certainly take communication blame here as well, is that sales incentives mean something to some people and different things to others. What we were saying is incentivise your staff around things that drive the outcomes that you are promising, not drive the short-term churn that is happening. So it's more so in the insurance, but certainly in the banking as well, that we all know, we go back to the same, shop who absolutely knows what size you are and knows that, you're comfortable in those shoes and you've got long-term customer outcomes and good relationships. Why can't we have that with financial products, and how is that displayed? And so about incentivise on long-term things that matter rather than the short-term dollar or volume targets.
I mean, with the good customer outcomes issue, that can be a very long time frame. Like, for example, with my mortgage, we could be talking 5, 10, 20 years, 30 years. How are you going to measure good outcomes in that type of area?
Well, that's going to be a challenge for them to answer, but I would just put that back. It's not like you sit here and now watch Gareth. There's quite a few Gareths who are banking with them, and there's new Gareths coming all the time, and there's Gareths that have been there for a long time. And so you do have quite a stock of knowledge and outcomes and information that sits amongst that data already to think about what works. I've been on the sales side. I've been a gamekeeper, poacher, been buy side, sell side. I have seen some things where the customers truly understand and want to come back to you because you have been honest, open, dealt with them, helped them through good times and bad, warned them away from particular products, or rung them and said, hey, you probably don't need that life insurance for that person anymore, they're no longer here, so on and so forth. So, it's not rocket science, it's just about making an effort to think about what are good customer outcomes. Some banks used to talk about whole-of-life experience. How can I get you in a savings account as a kid, help you through university, because I know at some point you're going to be worth a lot to me.
Now, obviously, in the Royal Commission in Australia, we had the final report out recently, and someone who we know well in New Zealand, Andrew Thorburn, was singled out and gone from National Australia Bank already. One of the questions in New Zealand has been, are you going to name individual banks, I don't know, even executives of banks, if you don't like what you see once they've reported back to you in March?
I would hope that things unfold in a way that if that comes to that situation, we probably wouldn't even need to name them. the institution or the individuals. That the process we're following, rather than everyone's guilty until proven innocent, which is the kind of the McCarthy process, that we are saying, here is your chance to explain, and if you're explaining well and it's very convincing, then why wouldn't you be shouting from the rooftops about what we are doing? What they themselves are doing. So there's an enormous incentive to self-disclose what you are doing and how it is improving. Otherwise, what's the effort? So that that is a particular challenge there. I don't know where the end point comes. The great news was we did not find systemic misbehaviour. What we found was widespread underinvestment across thinking in the space, and a lot of gaps which could lead to the risk. And in some industries, they don't know what they don't know yet.
Now, we'll move on to monetary policy. Obviously, you signed the new agreement with the Minister yesterday. You've obviously taken on employment, so now you've got price stability and employment as your two objectives, the dual objectives. And you're moving to this committee. I mean, you're going to chair it, and I believe there'll be a majority of RBNZ people, so 4 RBNZ, 3 outside people. To what extent is this actually going to change how the RBNZ formulates monetary policy and curtail your powers as governor?
Yeah, I think in terms of the formulation question, not a great deal. In terms of the deliberation question, I think it's going to be very powerful because it raises the level of transparency, demystifies, what goes on in that room, waiting for the white smoke, and it provides a wider, I would say, social legitimisation that we aren't being held hostage to a potential feral governor. The governor of the Reserve Bank in New Zealand is chased around because everyone thinks that that they are the only person. It's never been the case. So formulation, without doubt, the Reserve Bank's economics team will have the asymmetry of information and be able to produce a lot. But external people will bring in new perspectives, their own thinking, their own frameworks, etc., which we've already had. We've already had externals in there, but it makes it law rather than because we're nice people we thought that's a good way of doing it. The other part around the transparency is we will be publishing a record of the meeting, and that provides the richness to people like yourselves, to people, New Zealanders, around what are the types of issues that we're thinking about and the balance. I get frustrated at the monetary policy releases that the financial market look at 2 scenarios, and we try and make it symmetric because generally it's balanced. One goes up, one goes down, and then they instantly focus on those as if it's the only alternative other 2 paths that could happen. I know one thing about uncertainty, that there are more things that could happen than actually will, and this record of minutes will help. Curtailing my powers? No, the Reserve Bank remains operationally independent. And it's still got the double veto with the government. The Reserve Bank Board is still the overseer of my behaviour and the committee's behaviour. They've got a bigger job, both the committee as a whole and the independent members, and we're operating in effectively a glass bowl.
You've also got Phase 2 of the Reserve Bank Act review gearing up this year. We won't get into that too much today because there's a lot to it, and we can perhaps come back another time. But I was just interested in one point to start with, I guess, and that's the Reserve Bank's objectives. So this is currently around promoting the maintenance of a sound and efficient financial system. Do you think that needs to be changed?
I think it can be changed. One, no, it doesn't need to change. But 2, if it did stay the same, we need to do more work, the RBNZ, because my personal perception is we haven't put enough effort on the efficiency side. So what soundness and efficiency is what we write. What we talk about is financial stability, and efficiency should be a component of that financial stability. And so, as long as it's clear. I've noticed the central banks around the world, efficiency, they're kind of struggling to grasp what that should be. And I know, and even through your journalists, I get told off if I'm perceived to be roving beyond 1 to 3 inflation, if I start talking about labour market dynamics or productivity or climate change. People go, oh, look at this guy, he's climbing out of his own little box. Well, those are all things that are critical to the financial stability and efficiency of a country. So come what may, whether the words change or not, we need to put more effort into the more holistic view of what the central bank is, which is why we've been talking about all aspects of the bank over recent months.
Okay, just finally, I just was hoping to ask you a little bit about the issue of money creation. Now,
here's some.
We get a lot of comments on our site about this, and you're probably familiar with the papers that came out of the Bank of England 3 or 4 years back. I'll just read you a little bit from this. So one of the things they said is, when a bank makes a loan, for example, to someone taking out a mortgage to buy a house, it does not typically do so by giving them thousands of pounds worth of banknotes. Instead, it credits their bank account with a bank deposit of the size of the mortgage. At that moment, new money is created. Now, this has created a perception that banks can create money out of thin air and they don't really necessarily need to borrow through deposits or bonds from the public as they do. These two things seem to be at a bit of conflict. So I'm just curious as to what's the take from you?
They can create credit, and that credit has to be good credit because they need to get it back to pay the people who they borrowed from. And that's why we need more capital. So we are the only ones who have the monopoly right to create money per se, which is the notes and coins, and that is why we then set and make sure that our money remains worth something. That's why we keep it a low and stable inflation, and we make sure it's very hard to counterfeit so that people trust it and can put it in their pocket and a means of exchange. The banks need to borrow. They can either take it from shareholder capital or they can raise their own debt so that they can then on-lend. But banks can lend more than they borrow because they can have leverage, and that really comes down to about how much more capital do they have. But it all has to sheet back home to our interest rate and our amount of money, and if we see inflation running out of control, we always have the total ability to maintain that. So there's core money, and then there's the wider credit that's available in the world.
Is this an area that you've talked about much internally at the Reserve Bank, that in terms of the public understanding of how this works?
We obviously need to get better, judging by some of the comments that you've been talking about. And yes, we have, and we've got some publications, and so we will blow the dust off that and put it back out so that people understand what core money is, and then what the role of credit creation is, and how banks create that credit. And it's really critical, in particular, for the capital part of it, because if you only have to hold 10 cents for every dollar you loan, then if everyone comes back at the same time, if all the people that borrowed the money, lent the money to you, to the bank, comes back and says, I want it back now, well, you haven't got it. You've only got 10 cents in the dollar. And so they have to be comfortable that they have lent appropriately.
Well, look, thanks a lot for that, Adrian. That's Adrian Orr, Reserve Bank Governor, and I'm Gareth Vaughan at interest.co.nz.